Okay, hello everybody and welcome to Smack the Markets year-end performance review for 2021. So this session will run for approximately an hour. We'll see how we go. I like to make these things as open as we possibly can. We've got Fergal on the line as well. So if you're there, Fergal.
Hi everyone. Yeah, I'm here.
Super. And as usual, before we get started, if I can ask you just to take a few moments to read through the risk disclaimer to make sure that you're comfortable with the terms before continuing. As always, these sessions are recorded. We'll post it into the trading room so you'll be able to review it later on if you wish, and for access for those who were unable to attend live. Morning, Michael, all the way there from sunny Malta. Oh, and we even have a special guest of Santa Claus joining us today on the webinar. Superb. Okay, so just to recap here, we're not licensed to be able to give advice. The information that we give through the session today is purely for educational purposes only. Please make sure that you take the information in that in that sort of way. And if you're not happy with that, please leave the webinar now. Okay, so let's take a look at the agenda for today and what we're going to work through. So we'll come off with, first of all, the performance stats. So we'll take a look at the performance of the trading room from year to date, and also through the previous 12 months. So that's the calendar year for 2021 so far. We'll look at the year-end market wrap, and more importantly, did we get that Santa rally that we were all promised, that the markets promise us every year? We'll take a look at what that Santa rally actually is and where we stand on that at the moment. Then we'll go into some personal performance tips, and we'll bring Fergal in on this because he's got some very good tips here that may well help many other traders as well. We also go through some market observations that have come up, that are new things that are starting to develop within the markets that we've observed in the sort of previous few weeks to months. And then we'll wrap up with some of the new membership developments that are in plan for next year. So as always, I like to make these sessions as interactive as possible. So again, if you've got questions on the particular topics that we're covering here, please pop them into the questions box as we go and we'll address them. If you've got more generalized questions, then please pop them into the questions box at the end of the session. Okay, so trading performance for year to date so far. This is the graph that I normally show. This graph every year, and we show where we are on the official heads up calls only. Now, in the trading room, we talk about lots of trades. We discuss lots of different trading opportunities on a daily basis, but we only post out official heads up calls from trades which meet a certain sort of criteria. And we know what those are. They're effectively the safe trade. They're effectively the idea is that members can make follow those blindly and make a profit over the course of the year. The whole idea is to be able to earn a living from the markets. Now, from those calls, we've made a year-to-date gain of 64%. Now, a couple of observations that I'll highlight here is that one, for the first time ever, we actually went into negative territory. You can see back here in February, we actually dipped below the 0% mark for, well, probably 1 or 2% for a short period of time before the market continued. It's the first time ever we've done that. And I think it's probably signs that, remember, going back to the early part of the year, it was quite a challenging period of time. And you can certainly see periods here where we had some fairly flat sort of returns on our sort of equity, or not so steep, I should say. And that was due to the sort of sideways markets that we had going back towards the sort of earlier parts of the year. 64%, is that good? Well, it's under what my goals were. My goals have always been 100% a year on these trade calls. So we've come under on that this year to date. So let's take a look at these stats and break them down a little bit more detail. So taking a look at these year to date, we've had 48 number of winners and 43 losing trades. We know that's a total net gain of 64% so far. That equates down into winning weeks of 34 and losing weeks of 13. So from a psychology perspective, I think that's sort of quite positive. From a trading perspective, we don't really want to be having too many losing weeks. They are, they impact on our mindset. They impact on our sort of trading psychology. And as long as we're keeping having more winners than losers and more winning weeks than losing weeks, then of course that sort of helps to keep that sort of positive trader mindset. And one of the things that we'll be talking about in a little bit more detail later on. So the biggest weekly win was 8%. That was the 26th of July, or week commencing the 26th of July. We had an 8% win that week. Anyone remember what the biggest weekly loss was? The biggest amount that we lost in a week, or even maybe what week that was that we had that loss? Anyone remember? Anyone having a guess? Santa Claus must know. Talking of Santa Claus, I know who you are. I know it's Martin, and I know that, Martin, because your kids have already told me that you're really Santa Claus and Santa Claus doesn't really exist. And I know from your email address as well. So our biggest, okay, so Miles is saying 3%, Gordon saying 3%, Godfred 3%, Satar doesn't remember. Okay, so actually you're all wrong. It was actually more than that. So it was week commencing the 10th of May, it was 4%. We were 4% down on that week. Quite a big week actually for us. We don't normally have a loss of that sort of magnitude, but for that week we did. So from that, what were the biggest winners and loser trades of 2021? Let's take a look. So the question, the biggest loser. Now, everyone, give me an answer on this. What was the biggest loser? What was the biggest loser that we had over the course of the year? It's got to be an easy one. Andy, spot on. Godfred, spot on. Yes, we've got a lot of people actually. Gordon, well done. So we've got a lot of people coming in here with the right answer. And yep, all losers capped at 1%. So, we risk 1% of our trade or 1% of our trading account. So that's the risk. So the biggest loser is always capped at 1%. What's the biggest winner? So what was the biggest winning trade that we had last year? Anyone have a guess on that? A trick question, Michael. Yeah, maybe it should have, but it should have been an easy one. So we've got some interesting answers coming through. So Godfred, 5%. Yeah, that's good. And that's close, actually. That is very close, and you'll see why in a minute. Miles, yep, you're spot on. Michael, you're spot on as well. Super. So actually going through the stats, and this is one thing that's really useful for actually keeping records, is that you can drill down and pull out some interesting sort of observations. And it's always this time of year that I like to go through these and do a bit of review over the trading performance over the past year. So the biggest winners were, and here are the runners up. And we got these are all the trades here that I'd got in my records of 4%. Now, I'll bring Fergal in here because we had a bit of a chat about this, and there was a few that weren't actually strictly correct. So we had Great British Pound 4% on the 15th of February, Euro Swiss, which was up 4% on the 25th of February, CAD Yen, which was up 4% on the 1st of March. On the Aussie Swiss one, which was 4% on the 1st of September. Now, I was away on that week of the 1st of September. Fergal, this was a trade that Fergal called in the trading room. Now, in my records, I'd sort of got 4%, but I think Fergal sort of, you said that actually went on for much longer than that.
Yeah,
So
yeah. So that one, that's what I got out at 4%, but it actually, of course, went on, and I don't know what it went up to, but it kind of continued on for the rest of the week. But I remember as well, we were after coming out of August, and it was quite sideways markets and all of that. And maybe if we hadn't been through such a sideways action, we may have held on longer. But I remember that's what I came out at 4%. That's why it's 4%. But there was a lot more in that, and there was some more left in a few others as well. But we got out earlier. Even that dollar CAD, I think we got out. That's still going on actually. So yeah.
yeah, I mean, you mentioned also that the pound Aussie, I think you'd actually taken more out of it than I did on that one.
Yeah.
And what I tend to record here is where we've got out. Um, Obviously, sometimes I can make a few mistakes if I'm not around that week. Um, but sometimes these can actually sort of run on for much longer, of course, and you may well have managed trades differently to the way that we do. Of course, that's another thing. Now, the biggest trade that we had was a recent trade, and well done for Miles for nailing that one, and also Michael for nailing that one as well. It was on the 9th of December. It was dollar CAD. It was that trade that we had. It was 11% in total. It was actually a trade that we had stalked for quite a long time. So it was building up. It wasn't a surprise trade, and we actually posted it out the into our newsletter anyway on that one. Now, this is the trade setup. Now, I've actually managed to pull this down to a 30-minute slide, a 30-minute time frame. I've had to pull it into a 30-minute time frame to get the whole trade onto one page here. It was executed on a 15-minute time frame, but at the same levels. So you can see here, this is how it sort of ran. It wasn't the smoothest of trades at all, but it was based upon the trading decisions that we made at the time, and the overall target was that at the time when we took the trade was pretty much an aspirational 128, which got us up to this level here. So the 11th target was just under 128. So as you can see, what sort of happened after that, well, the market actually smashed through 128, went on. You could probably have actually got maybe 12 targets out of this. And if you held on for a bit more and took a little bit of heat on it, you may have even got even more targets out of that. So that's how the trade played out to our trading plan. But if we'd kept into it, this is what the dollar CAD looks like now. And this is how it looked like yesterday, I should say, when I pulled this slide off. So you can see, if you can see my cursor here, this is the part of the trade or part of the trend that we took the trade in. So it was off this bounce on the daily, off this level at 126,233. we got in shortly after that, and the market ran up to the 128 level, which is this blue dotted line here. And that's where we got out. You can see that the market's actually rallied on much further than that. So were we right to get out of the trade at 128? What do you think? More importantly, I'll tell you what, I'd be interested to know, is there anyone else that's still in this trade? Anyone that's taken it and still in it? If there's anyone that's still in it, I'm gonna go and teach myself how to trade again, I think, over Christmas. Well done if you are. But I think here the plan was to trade it up to 128. Obviously, since the market has gone through that 128 level, we didn't know how it was going to perform after that. We didn't know that it was going to run right the way up to the next and close the next trading window. I can tell you that the analysis that I was looking at at the time was all of these highs that you can see going back for quite a long time actually. This chart here is a daily chart, but this goes on. You've got quite a significant level in here. And I think this was really the reason as to why I didn't want to hold into this, just for the fear of the fact that the market may actually run out of steam like it did here. And I think this part of the trade here, the next part from 128 to close, moving up to the next trading window, that was possibly another trade. Although Fergal, you're going to tell me now that you're still in this, aren't you?
No, I wish I was. But the other interesting thing I think about that trade was that, it was taken 3 weeks ago, I think, or something like that, or close enough to 3 weeks ago anyway. But if you look at the dollar index chart, the dollar has been trading sideways for 5 weeks now. And, we were dependent on dollar strength there really for that to play out, and we didn't really get it. So this was all on the back of the caddy. And I remember that morning when you called that, and, the markets were quite sideways. This just had broken out and we just got in on the first pullback. But it kind of goes to show that even in spite of the dollar index being so sideways for the last 5 weeks now, that there's still opportunities there, because I think the Canadian had an interest rate decision there a couple of weeks ago, and their tapering is going a little bit faster, so that's weakened it a little bit. So it's just interesting that this was all on the back of the caddy, not the dollar at all.
Yes, and a very good point actually, because that dollar index has just been sort of stuck in that sideways range for such a long time, and I suppose it's just sort of testament that sometimes when you're trading a currency, it doesn't have to be sort of perfect strengths and weaknesses all of the time for both of those currencies within that equation. It can be a sort of defined weakness in one side of the market, which is enough to actually pull the trade, particularly if the other currency in the equation is not doing anything, if it's just sideways, which is what we've had here with the dollar. So I agree with you, Miles, actually. So Miles says that he thinks it's right to get out when we did, and maybe consider another trade once the market sort of got above that 128 level. Well, that's exactly what we did. So that was the plan. It's always easy to look back in hindsight and say, I wish I'd done this, I wish I'd done that. But it's always also a good idea to trade your plan. Even actually looking at the charts now, we won't go into the sort of technicals, of course, but even looking at the charts here, you can see that the market did rally on, but there were some sort of indications here with our indicators indicating that the strength of the trend was potentially sort of weakening as well. Okay, so that was the biggest trade that we had over the past year. So taking a look at the trading room performance year to date. Now, we know what we've done so far this year. To date, since we started, the performance chart looks like this. We've got performance of 283% to date. Again, this is on the official heads up calls only. So nothing, only those ones. And of course, with these heads up calls, we don't include the trades that we take on tick charts or the trades that we take on the US equity markets on those lower time frames, because they're too fast, too lower time frame to be able to call out a trade. So these are predominantly on 15-minute time frames and above. So 15-minute, 60-minute, 4-hour and above, which gives us an average of 81% a gain per year. So that gives you some sort of indication that the 64% we did this year was not our best year at all. In fact, last year we did 97%. So yeah, it's closer to the 100% that we were aiming for year on year. So just some interesting stats there for the performance of the trading room. Okay, so let's move on and take a look at the year-end wrap for the markets, and more importantly, did we get that Santa rally that we often get? Now, I suppose one of the questions is, did we get a Santa rally, or are we still going to get one? And I suppose the question here is, let's define what the official clarification is of the Santa rally. And there's not really an official sort of clarification of this. I'll explain why. Historically, it refers to the run-up week to Christmas and the trading period in between Christmas and New Year. So this means this particular week of the run-up to Christmas that we're in at the moment, and the sort of normally 3 trading days that we have in between Christmas and New Year. Now, the reason for this is that historically, over the past sort of 100 years or so, this has been the period that's been the most bullish time of the year ever. And the reasons for that is down to this. The institutions are on holiday, which means that there's lighter volumes in the markets. It also means that the markets are left to the retail traders, and retail traders tend to be more bullish. You also find that everyone's in a good mood. We're in party spirits normally, and we've always had a visit from Santa Claus or Martin, whoever he is, and we're all in good moods. And of course, typically with businesses, they've been, particularly retail businesses, they've been doing particularly well over that run up to Christmas with the sort of Christmas shopping. However, in more recent times, the Santa rally tends to be referred to in trading terms over the trading performance of stocks over the whole month of December. So there is a bit of a bit of sort of difference there, depending upon who you speak to and how they're sort of recording this. But typically, or historically, we're right in that sort of Santa Claus period at the moment. But this could also be referred to over the whole month of December as well. So let's take a look at where we are at the moment with the 3 major US index markets. And this could be quite useful, particularly for traders that are trading over that Christmas period. If you're trading for the rest of this week and also into next week, this could be quite useful information. So if we take a look at the Nasdaq, we've got the weekly chart here. The small one I've got over here on the bottom left-hand side is the monthly chart. And you can see that where the month started. So for the Nasdaq, the month started at 16,242.75. These are the futures prices that we're looking at here, by the way. So if you're looking at a cash market, that's going to be a slightly different number, but the chart structures will look the same. So looking at the Nasdaq, the market has come into this quite strong support area. It's around sort of 15,500, 15,550, that sort of area. You know, this has been here on our charts for the past few weeks. You can see here for the past 4 weeks now, the market has been testing these lows. Very interesting that in the face of all of the negative news that we've had over the recent times, you know, the increase in this sort of new COVID variant spreading throughout economies, countries now locking down again, putting restrictions in place for business and socializing, which is going to impact on company returns, and the start of tapering in the US, and of course the rising interest rates. All of these incredibly bad news for stock markets, and out of all of the stock markets, the worst stock market for this is the Nasdaq, and yet the Nasdaq's actually finding support here. That's unbelievable. Now, I'm not suggesting, by the way, that this is going to hold in next year. I'm just talking about the Santa rally. So if we take a look at the daily chart, you can see that there are some significant structure points here in the daily chart. And I think here that 16,400, that level that we've spoken about many times before, significant resistance here on the daily chart. Now, notice that for the Nasdaq to actually increase stock prices this month, it needs to move above that 16,000 level, which the market's just capped under at the moment. It needs to move up to 16,242, and that's not far. So that's halfway between this trading window from 16,000 to 16,400. So it just needs to push a little bit higher. And that, I think, there is a fair chance that things might achieve that way. From a technical perspective, I don't think these chart looks particularly healthy going much further forward, but we might get a bit of a bounce. It might be classified as a Santa rally on the Nasdaq. Now, if we take a look at the Dow is much more bullish. The Dow is already into a Santa rally already. So you can see here on the monthly chart, we're already above the low, or above where the market started. You can see here on the weekly chart, even though the market has sort of pulled back rather healthily, we're still looking fairly reasonable here. We're still getting major higher lows on this market. And I think the lows here of 34,000 and 34,700 are going to be the significant points for the Dow. You come down to the daily time frame, and again, we've got a similar type of thing here. So the big level of resistance for the Dow is at 36,000. You've got our levels here at 34,000 of support, 34,700. Again, there's plenty of time here that the market could move a little higher. Remember, even if it stays where it is, historians will always say that this has now had that Santa rally for this year. If we take a look at the S&P 500, the broader market, this one's a little bit in between the Dow and the Nasdaq. And you can see here on the monthly chart that, again, we are above price. So the market has rallied. Stocks have moved higher so far this month. Looking at this on the weekly chart, well, overall, the weekly chart does look particularly bullish still. So we're still looking sort of quite strong there from this candle action. I think in all of these charts, the strength of momentum is starting to weaken off, but price action is looking a little bit more supportive. Taking a look at this on the daily time frame again, and again, we've got some very decisive levels on these markets. 4,700, or sort of 4,000, 47,000, very, very significant level on this market. Again, a bit like the Nasdaq that the price couldn't get through in the past. Again, we've got that support at 4,500, and also the slightly higher at 4,535. At the moment, again, markets and prices are higher than the beginning of the month, so these don't have to do an awful lot more to hold up there. So at this moment in time, the way the markets are looking, and of course there's still time for this to change, but it's looking like the historians may well be putting down that in 2021 we got a Santa rally in the markets. Maybe it's nearly there, but the outlook for 2022 isn't looking quite so positive for stronger stocks, of course. Now, all three major indices that we've just taken a look at have got significant resistance levels to breach in order for those markets to move higher, and that's the Nasdaq, the Dow, and the S&Ps. On top of that, there isn't actually a bundle of massively good news out there. There's a lot of rather negative news for stocks. Of course, on top of this, of the taperings in place now, that's accelerating. Interest rates are rising as well, and that's going to erode one of the biggest USPs that stocks have had since the start of the pandemic. What's been driving stock prices higher has been stimulus. It's been government and central bank printing money, and the fact that interest rates have been at historical lows and virtually nothing. So there's been nowhere else to put your money. So you might as well put it into the stock market. Now there is, or in the outlook going forward, there is going to be other places to put your funds, and safer places than the stock market as well. And that may well take some of the sort of shine away from the attraction to putting it into the markets. So it can be an interesting year next year for stocks. So okay, let's move on to personal performance tips. So I'm going to bring Fergal in here, and Fergal's going to take us through some of the nature of trading here.
Yeah. So can you hear me okay again? Hello.
Yep,
Can you
can
hear me?
hear you loud and clear.
Okay. Okay. So this is just some sort of, after the year we've been through with the equity curve dipping below zero for a period of time that never happened before, and looking at the equity curve there, we have, I think we hit 20% around about early April, and we didn't really. I think we dipped above it slightly, but then we dipped below it, and it was in early July again before we got some traction again. And once July came, then we, the other 44% was made in that period of time. So there was quite a significant period there that was difficult. It was 2 months or so, or 6 weeks at least. It was difficult sort of trading water sideways, some up days, some down days. But that is the nature of trading, and I think it's a good idea just to look into that a little bit. And I just, I was reading some books this year, and one of them was Steve Ward's, and it's a fantastic book if anyone's interested. It's Bulletproof Trader, it's called. But there was some really interesting nuggets of information there about getting through these downtimes, and basically facing up to the reality that trading is going to be a lot of downtime, and this is going to be part of the job, or this is going to be part of life as we go forward in this journey. So it's just getting good at the downs and trying to, the idea here is if you can just tweak a few little small, very easy things that you can sort of apply to your daily routine or your mindset, just to turn up that a little bit, just by 10% maybe, just to improve those downtimes, because that's when we do the damage, and it's bad enough having some losses, but also behaving in a way that isn't very professional, and maybe taking some bad trades and some trades that don't adhere to the rules and all of that kind of stuff. That's just going to exacerbate the whole situation and make things much worse. And the experience then will be much worse than it needs to be, because we're not going to get away with this without having negative experiences. There's going to be quite a significant amount of this that are going to be negative experiences, and you just have to embrace that, really. Like the some of the pointers there. But and the other interesting stat that I came up with this year was that apparently research shows now that the pain of losing is twice as the pleasure of winning. So if we've got a 65 or 70% win rate, that's still quite a lot of losing. But if the effect on your mindset is worse than that, then that's a lot of losing. So we have to get good at this, and we have to embrace it, and just embrace uncertainty, and get a little bit better at managing ourselves during these times. So there's a few things we can do, about building confidence and things like that. And I suppose motivation then is the thing that everybody talks about. And I think the more time that people spend on motivation, they kind of know that it's not exactly so tangible. You can be very motivated one day, and the next day you're no motivation at all. But the word everybody's using now for performance is commitment. And if you are committed, you override motivation, really, and I think that's a much better way and much more structured way to just get through this. Because if you're having bad experiences and you're getting some negative equity curve and it's dipping below zero, or you're going treading water for 6 weeks and all that, that's going to be quite difficult. But if you're committed, you can override all of that, and you can just make a promise to yourself that I'm going to be at my desk regardless of what's going on, and I'm going to do this regardless of what's going on. And get through those difficult times and get the reps in, basically get all this experience in regardless of what's going on, because we're not going to get anywhere without these experiences. And I'm sure we'd all learn to be fantastic traders if we had 30 years full time, but we don't have that kind of time, and we want to be able to, a word Simon used to use with me a lot at the beginning was we need to short circuit a lot of this, because if you don't short circuit it, it's going to take far more time than we really have. So motivation, I think it's better to get committed about things. It's much more long lasting, as I say there. It cuts through motivation. And it requires just to take that effective action in the moment, and that's put motivation out. Then you're just committed and you've overridden that. But if you want to move on to the next slide there, Simon, I think I can.
Yep. Actually, Fergal,
Yeah.
you're spot on there, because one of the things that you always find is that you always remember your losing trades, no matter if you've had a whole string of really good successful trading for the past 3 months. If you have a week of a tough week, that tough week you're going to remember for much longer than you are going to remember the successful trades. It's something that you always resonates with me. And you always think about, when you come back to to some of these things, the alternative. What I always used to think was, it might be painful, it might be uncomfortable going through that sort of learning curve, but the alternative to me was never very attractive, and that was, the alternative was to go back to the day job, and that was definitely something I didn't want to do. So that helped to keep that motivation, to keep that sort of determination, and that commitment to pushing through those more difficult times.
Absolutely. Yeah. Think of the alternative. So but the other thing, I suppose, just to to push on from that a little bit, and to kind of put something, nail something down that you can count on yourself to do during these times, because as everybody knows, when you're stressed or you're pretty frustrated with the markets, you're not thinking in your usual calm mind, and you're not seeing the opportunities. And that's been well documented at this stage, that you're better to be calm and focused on the markets, and looking at it in a proper picture, rather than this fear or flight or stress or whatever. That's not ideal. But to build confidence, I heard this analogy and I thought it was quite a good one, and it applies to trading quite a bit. About building confidence is like putting legs on a stool, and the more legs you have on that stool, the better you're going to be able to deal with these difficult times. So if you can, to make a very simple example, if you're the kind of person that, when things are going bad, and if that bad means 3 losses in a row, if it means 5 losses in a row, it depends on what kind of person you are and how many trades you take and all that. But if that's what triggers you into these difficult times, then you need to have some rules there. And just one thing you could do is just say, I after, and we've talked about this plenty of times, just put in a stop loss thing, or a circuit breaker, where you say 3 losses in a week and I'm out, and I just stop and I don't take any more trades. But you need to have these things, and you need to be able to count on yourself to do these things, because if you can't count on yourself, then you are going to make it worse, and it's only you that's making it worse. It's not the markets, it's not anybody else, it's just you. So if you have that there, and you can say, right, when things get bad, I know how to stop, and I just always stop, and I actually don't make things that bad at all, and I get through it, then you have that leg of the stool, an extra leg of the 3 stool, or whatever it is, to enforce that. And the other thing could be, some people suffer from fear of missing out, or FOMO. And if that's something that you just start acting a little bit crazy with the markets, and you see, oh God, somebody else got in here and I missed out, and look at it, so there was 2 opportunities I missed there and I just didn't get in. But are you thinking logically then at that point, or are you just thinking a little bit crazy again? And if you are thinking a bit crazy and you start doing things that are clearly a little bit not right, then just say, if these FOMO situations arise, I can trust myself just to step back and say, okay, because the last few times I was here, I made an absolute hames of it, or whatever. Then I think you have to be able to rely on yourself, and there's different things you can do just to put in these little aspects to your trading that will help you get through these times, and also just stop making them worse, because I think a lot of the damage is done. It's bad enough having to go through a bad period of time, but the way we behave during that and after that is a lot worse. And then, you know, these, if you are coming up, and I suppose this kind of leads on to a little bit about that dollar caddy trade. You know, we always had, you know, we generally have these windows of potential ahead of our trades. And if you're struggling with anything like that, you know, you just, one of the things, and everybody knows this, I'm sure at this stage, is you put in these if this happens, then rules. And if the trade gets to closing the window, you close out. And if you're happy to do that every time, then it takes out the decision, and you don't have to go, damn it, I should have stayed in. Look at it's gone on to 10 to 1 now. Why didn't I stay in, and all of this kind of thing. But I think at the beginning, anyways, of people's journeys, just it's better to have these rules and to stick to them. And then there's no kind of room for debate or beating yourself up or regret or any of that. If you have these rules and you stick to them, that's the rules. And if you decide in 6 months' time, you know what, the markets are kind of stretching out a little bit more, overextension, you know, might be, you know, not as important, then you can maybe adjust those rules. But that's another thing you can just implement very simply, I think, and it can improve these difficult times, even by, you know, a small percentage, 5 or 10%, could make a huge difference to somebody, from the experience point of view, but also from the just P&L basically at the end of the year. And also, you know, confidence. Then, you know, you have to, and I suppose it's sort of analogous to the what's going on with these lockdowns. You know, every time these lockdowns come nowadays, we're trying to think, oh my God, how's this? How can we be here again? And then you get through them, and next thing things are fine again for a while, and you get another one. But that's a little bit like trading, you know. And there's plenty of experienced traders in the room now. They've all been through tough times, I'm sure, at this stage, and you've all come through them at this stage as well. So what kind of stuff did you do to get through them, you know, and what did you do to overcome that period? Was there a period of time that you actually came through it quite easily, and what did you do that time? And, you know, plenty of questions around that. Then, like, what are your strengths and weaknesses when that comes in, and what, you know, what can you do better next time around, and all that, and to rely on yourself again to be able to say, this is tough, but this is trading. I got through it the last time, and I'll get through it the next time, you know. And, you know, we know these periods can only last for a certain length of time anyway. So I think that's kind of it. You know, I don't want to go too much into it because it's a huge area, but I think there's a few little pieces there that can be implemented fairly easily and could make, you know, a small difference that could make a big difference in the long run to these difficult times. Because last year was, or this year was, you know, quite a case in point really on this. So and then the other thing, just the last blue box there, you know, ask yourself, you know, and to nail this down, you know, to get from A to B where you want to be, like, what are the challenges and demands you face in trading the markets, and be precise and exact about them. And then what do you need to do in order to meet those challenges and demands? And if there's anything that includes asking us for stuff, or what the room can do for you, or if there's anything else, you know, that you need to do, or if you have weak points, and face up to them, and just say, I'm quite poor at this, and this is something where I clearly need to improve on, and you know, start working towards that. But I think it's important to be honest and exact on that, and you know, that's kind of how you start taking steps towards getting to where you are, I think. So
Yeah,
that's
I
it,
agree with
Simon,
you
kind of,
there
you
on
know.
Fergal. I think these are some of the great topics that we might actually be able to expand upon. Actually, run another webinar early next year, and
Yeah.
expand upon some of these things, because some of these sort of rules, that some of these sort of what if rules, you know, if this happens, do this, they can really sort of help to, well, what they do is they put sort of discipline and
Hmm.
help to install discipline into times when you're losing discipline, and that can really sort of help um, to cause more damage, you know. Often,
Absolutely. Hmm.
you know, and even through this year, we've gone through some rather long periods in this year. You go back, I mean, it's again, it's we seem to remember what's happening now or what's happened last week. um, go back a few months, and there were some fairly long periods of time where markets were just really sideways, and not a great deal of trends. And you think back to then, and you think, well, I can remember thinking back at that time, thinking, what's going on with the markets? You know, this is getting really sort of disappointing.
Hmm.
But I've been around these long enough to know that markets go through these periods of time, and you just have to sit through them until the good times come along. Don't blow your trading account up
Hmm.
trying to trade. Uh, sideways market.
Yeah.
But
And I think as well, that dollar CAD and even that one I remember, the Aussie Swiss, they came just by out of the blue almost. There was no real signs that the markets were beginning to move quite a bit or anything like that. They just presented themselves. We were there to take them, and they turned out to be probably the biggest trades we had this year, in spite of coming through a period of 3 weeks of quite flat markets, or maybe 4 weeks or 2 weeks or whatever it was. So again, it's kind of just about persevering through these things, and to be there to survive the curve, really the learning curve, and to be there to take these opportunities when things do present themselves in a better way.
Yeah, exactly. So this was the next slide. So these well, you take it away, Fergal.
Yeah. So just to sort of some interesting things. I think that the markets kind of changed a little bit this year. There was different sort of characteristics in the markets that we hadn't seen before, or I don't think I've noticed them before if they were there. The Fed blackout is one of them for sure. That's only started recently. That was the lead up to the FOMC meeting last Wednesday, I think it was, or the Wednesday before that, where there's a 10-day Fed blackout. And what's that going to mean for the markets? And myself and Simon kind of talked about this before, but there was, maybe go back a further month, and there was some evenings there in the afternoon you might have 6 or 7 Fed speakers, and it was almost impossible to trade. So although it may reduce the volatility and movement on the markets and the dollar markets, what's it going to do? And maybe is it a net positive, really, that we don't have these guys talking in universities and committees, saying buzzwords that we know that'll move they know that'll move the markets and maybe get us stopped out or whatever. So, what do you think, Simon, about that?
Yeah, I mean, it's an interesting one, because my first thoughts are I'm happy that they're quiet, because it has been very distracting that we've had days, like you say, that you get Fed speaker after Fed speaker after Fed speaker, and they're all talking, and whatever they're saying will be creating volatility in the markets, and that can create sort of choppy price action. I think for me personally, I think I rather like it, the fact that they are quiet. It means that it does unfortunately mean that we have a bit more of a surprise with the news when it comes out, and when decisions are made, because we don't get sort of the preemptive information on it all of the time. But it does mean that we get periods of time where the markets are left to themselves, and they're not being sort of manipulated all of the time. So that should make for easier or cleaner price action, I hope, but we'll see.
Yeah. We thought when it happened first, there was a lot of sideways action on the dollar index, and then we had the FOMC, and then they were allowed to speak again. But since then, the dollar still hasn't moved an awful lot. So maybe the dollar just isn't moving for the last few weeks. But to move on to that, another thing I noticed, and I'm sure everybody else has noticed it too, that the pound, it seems to be very volatile this year, and I suppose it's not surprising with quite a few things going on with trade deals and so on. But it, a lot of the time it could be on either side. It could be the strongest in the morning, and then by 9:30 it could be actually the weakest. And we saw quite a bit of big swings, and hard enough to pin some of them down to actual fundamental stuff in the background. So in that sense, I think it's probably, I think it's been a little bit more risky this year. That doesn't mean we're not going to trade the pound or anything like that. Some of the best trades have been on the pound, but I think that's just another factor that has been this year. Maybe things will settle down next year now, but it's one of those things that seems to be happening. The other thing is overextension. So, it's just something that seems to be happening a little bit more this year, that when we get an interest rate announcement or policy statement from central banks around the world, that whatever, and there's a huge amount of focus on it with the coronavirus and all that. So that seems to be almost the main thing that people are focusing on. But, the things just seem to move and break the daily high day after day, a lot of the time without, go back 5 years ago during the Asia session, they would a lot of the time retrace back into sort of, fib zones and stuff like that. But nowadays, not that it doesn't do that, it still does that, but it seems to have this new kind of characteristic of overextension not being as important as it used to have been, and even when they are overextended, still having quite a bit of legs to continue on for, so a couple of 100 points more than that. And these are the other ones that you came up with, Simon. Then do you want to talk about
Yes.
these? Yeah.
Well, I suppose the tick trading moves, it's a bit like overextension. Those, when we're trading on the tick charts, particularly sort of US index markets, even some of those metals as well. And I'm pretty sure that the tick traders that we've taught those specific strategies and techniques to recognize this as well, is that these days, some of these moves, when they move, they just move, and they can run for pretty long stretches before pulling back. And that can make sort of getting into some of those moves sort of fairly challenging. I've observed in recent days some moves on markets like the Nasdaq moves 50 pips without actually a pullback, and and these are on tick charts, so very, very low time frames. So it just makes things, again, a little bit more challenging. I wouldn't sort of suggest changing your trading technique or strategy to adjust for this, but actually being a bit more aware of them, that these things can happen. Notice that when trading windows get broken, markets tend to move to the end of that trading window. That's what we've been observing. So noticing that means that I pay a lot more attention to the way price action reacts around those breakout areas. And again, that's a little sort of observation that we've started to notice. It means that some moves ultimately you don't get into because you can't catch them. But it means other moves that when you can catch into them, you tend to sort of hold into them for a bit longer and actually see if these will actually give you a bit of a run. And when they do just run for these long stretches, then they can become rather rewarding. That last one there, I'll pick up on that if you want, sort of Fergal.
Yeah.
There seems to be more defined longer periods where particular markets consolidate and do not trend. I think that's something that we've seen for quite a period of this time of this year. We've seen that taking place with the dollar. We've spoken about that a number of times. There's been many other markets as well that have just been consolidating in sort of rather tight sideways ranges for, well, weeks and weeks and weeks. And again, that sort of means that those markets just get ruled out. We're trend following traders, so the whole methodology of our approach to trading the markets requires a trend, and it just means that those markets then get sort of moved out of the watch list until such a time as they break out and start to trend. This is something that we've started to see a lot more of, more so I think this year than I've can actually care to remember. But again, this is a characteristic of the fact that we've got interest rates that are pretty much zero across most of the globe, particularly in the excluding the exotic markets, of course. But going forward, we're now starting to see interest rate rises and interest rates starting to come in. So I think this is going to likely to change, and we're likely to start to see some trends starting to form in some of these markets, which are going to be sort of a bit more longer running than what we've had over the past year or two. So anything else that you've got to you want to sort of say on that slide, Fergal? Are we happy to move on?
I think that's it really. Hopefully, if this coronavirus, if we get a handle on it, maybe things will start changing. And the other thing we had this year, I suppose, is that a lot of the pound news now comes out at 7 o'clock. That was usually a 9:30 slot, I think. So that's also, some of this coronavirus has affected the markets, no doubt.
Yeah.
But that's about it, Simon. Yeah.
Okie dokie. Right. Let's move on to membership developments for 2022. So these are just some of the things that we've got plans now for new services developments going through into next year, and we just wanted to share some of these with you. So some of them you already know. So the trading room is closing to new members. I've spoken to you about this before. There's a number of reasons behind it. Uh, Unfortunately, there are a lot of um, wonderful supersonic traders out there that post astronomical gains in social media, and it tends to sort of give an awful lot of pressure onto many other providers that perhaps are maybe sort of a bit more sort of honest with their with their trading performance. What it means is that I get a lot of inquiries from potential new members that are looking for something that the trading room really isn't. Um, and it's not going to be a tipping service that is going to just sort of take you from rags to riches. It's something to support good traders that know our trading methods. So what we're going to do is, the regulators are caught onto this, and there's a lot of those more sort of unscrupulous providers that have come under a, a lot of investigation with some huge fines as well. So I don't want to get involved in any of those things. So what we're going to do is we're going to close the room to new members from the 17th of January. It's from that point onwards, it's going to be by invitation only. So if you know us, if you are familiar with our trading methods, then you can contact me. We may well give you an invite to join. We'll also have then membership will be offered once a suitable qualified you're suitably qualified within our trading methods, and that will sort of lead on to the next point that we're going to say. Now, what I've also you'll also see on our website is that as a closing offer on this point, we don't ever put offers on this, do we? We've never had sales, we've never had offers, and this is the first time ever that we've actually put an offer in there. So you can join and lock in the lower price, saving £30 per month every month for the lifetime of your membership, and that's for anyone who wants to join before the 17th of January, and then that will disappear. So what this will lead us on to then is that, and again, we've spoken about this before, that and some of you have actually submitted some very, very valuable information to help us with content and how the sorts of things that you would like us to include within this. So we're going to run a trader trading academy. It's we're not sure exactly when it's going to be launched. It'll probably be Q1 next year. So within the first 3 months, it's going to be a training program. It's going to teach you the methods that we use to trade the markets, the methods that we prove day in and day out, and you see us trading every day. And we'll deliver that through an affordable program. I even want to make it free. So I'm not really interested in making money out of this. So it's going to be free, or it's going to be very affordable options to join. It will be free to all current members. So if you're a member of the trading room, you're going to get this free anyway. So it's going to be in a trading academy. It's going to be something that if you want to brush up on your trading skills, for example, or you want to revisit any of the sort of areas that we use, then you can dive into this and you can go and take a look at it, or you can just go through the whole thing yourself as a bit of a refresher. New services. Well, there's a number of different things that we've been asked for over the past year, and I've listened to all of them. Preferential spreads. We're traders. We all want good rates, the best rates possible. So again, these are some of the things that I'm looking at, and we'll try and deliver. So preferential trading spreads, possibly a better trading platform, a bespoke trading platform, spread bet trading for Ireland. Now, many of you have said that, and I've heard that mentioned a few times now. So that is something that I'm working with, and also social events and social meetups. Now, interestingly, we were trying to do something for December, and it was a good job that we didn't. We were planning on um, doing some kind of event in London in the early part of December. We didn't go ahead with it, and it was a good job that we didn't, because Fergal got ill that week, and the coronavirus restrictions started to kick in for traveling. So I don't think Fergal would have ever been able to have travelled anyway over to the UK, and that week was when everything started to kick off in London. So I don't think anyone would have really wanted to have travelled down to London to meet up anyway. But that said, assuming that when this virus allows us, it will be nice to be able to arrange some social meetups, possibly some trading events, or some sort of events that we can organize, maybe in this country, maybe others. We'll have a look. But that's the plan. It's always been the plan, actually. And leads me on to, really, what other new member services would you like to see in 2022? So again, we're very open. So if there are things that you would like, things you'd find useful, then let me know. So drop your answers into the questions box, and let us know what you want. If you think of something later on after the webinar, then you know how to send me an email or contact me on social media, and pass that information on. That will be very, very useful. So let me just take a look at the questions now. We've got a few coming through. Do I think that Brexit has changed the timings of morning market moves? To be honest with you, I haven't really noticed that, to be perfectly honest. Nothing to do with Brexit anyway. I mean, Europe sort of opens up a sort of an hour before we do in the UK anyway. The early morning moves or early morning is always a good time for forex markets. I think that's always been the case, and I haven't really sort of noticed anything sort of substantially different in sort of recent time, I suppose, from going back over the past sort of several years. So, and I don't think there's anything sort of particularly with from a Brexit perspective that has had an impact on it. What I can say, though, and going back to what Fergal mentioned earlier, is that the Great British Pound does tend to be a bit more volatile. I've always known that cable has almost got a bit of a mind of its own. It's a particularly sort of choppy market. One of my favourite markets is pound yen, and that one is again tends to be a bit, and in fact, all Great British Pound markets tend to be a bit more jumpy than and less smooth than they used to be. Okay, so let's move on and start to wrap up. So, I mean, this just brings us into the end of the session here. So the trading room schedule for the holiday period here, we're closing and wrapping up at the end of trading on Thursday, the 23rd of December. Remember that some markets will be open for a period of the day on the 24th. There will be some trading days in between Christmas and New Year, but we won't be operating the trading room during that time. A lot of the professional services and the backup services that we use will not be running at that during that sort of period of time. Again, all the institutions will be closed. So there are some markets open. We will be reopening again at the start of European trading on the Tuesday, the 4th of January. So if you've got questions, now's a good time to pop them into the questions box, and we'll take a look at those as well. Just really brings us into sort of wrap up for the end of the session here. And I'd just like to say, well, thank you very much for everybody that's joined us here for this webinar today. We've got people that are members, people that are not current members. We've even got Santa Claus himself. I know you, Martin. Joined us too. So thank you very much to everyone who's taken the time to join us on this review. And hopefully, this has been useful, and hopefully this has been of interest to you. And we've managed to sort of pull together some good information. Hopefully the stats have been of interest to you as well.
Yeah, and I just want to echo that, Simon. Just a happy Christmas to everybody and New Year, and looking forward to getting back to the markets. We'll be here tomorrow, obviously, but back in the new year as well. So hope everyone has stay safe during these sort of difficult enough times, and in spite of everything, have a good Christmas.
Yeah, so just taking a look at some of these sort of questions. So a very good question here, actually. So how many years trading experience needed to see the consistency gain? I mean, I suppose that's the multi-million-dollar question. For me, I've been trading a long time. I think that there is an awful lot that I could have cut out. I could have improved. My trading journey could have been substantially shorter had I have perhaps had someone like me, perhaps, or someone like Smack the Markets at the time. So I think there's a lot that you can cut out. There's a lot you can short circuit, by having that sort of guidance, by having that that sort of information. It ultimately depends very much down onto yourself, but it doesn't mean to say that you've got to spend 10 years trading or anything like that. I think, trading is a journey, and what you start out with is typically you start out with maybe not doing very well at all. When you're sort of finding the ropes, when you sort of start to develop a plan, and you start to then follow particular trading strategies, and you learn to sort of read price action, then things start to come together. And you tend to your sort of journey tends to sort of go like a bit like an equity curve. It tends to sort of like improve, and then what will happen is the markets will change, and then you'll take a bit of a dip because you won't recognize the change. You won't recognize to change yourself and your trading approach to adjust to the markets. And then you'll realize, and then you'll stop, and then you'll make adjustments for it, and then you'll start to build that equity curve back up again, and your trading will improve. That's generally the sort of way that it tends to go. You don't need to be trading for 10 years in order to be able to earn a living from the markets. You can do that much sort of sooner than that. I suppose, to one extent, some years ago, I had a client who I taught to trade. It was a brand new client, hadn't traded before, and within about sort of 6 months, he was trading a $50,000 trading account, and he was doing extremely well out of it. So that took him about 6 months. That's probably about the best that I know of through my own sort of experience. But I would say for most people, it's a journey. It's a journey. I mean, let me know how you're doing. Okay, so just taking a look through some of these sort of questions. A lot of thanks and good wishes. So thank you very much, everybody. So okay, so yeah, wonderful. Thank you very much to everybody. Thank you for all your kind wishes as well. And again, we'll be here until tomorrow evening. So it's going to be still back in the trading room until tomorrow evening. But leads us from both of us to wish you a very, very great Christmas, a cracking new year as well, and what's shaping up to be a very, very interesting 2022. We're looking forward to trading with you through that as well. So thank you very much, everybody.
Thanks, everybody. Have a great Christmas.
And let's wrap it up for now. Super. Thank you very much. Bye for now.